Hey there, let's talk about housing in San Diego in July. My name is Cleve. I'm a real estate broker and native San Diegan. And we are getting into kind of the middle of the summer selling season. And things are getting a little bit quieter, kind of a subdued summer. Um, Buyers and sellers, typically transact year round. Spring happens to be the busiest time of the year on the demand side. But you get into summer activities. The kids go to camp. You have travel plans. Um, it's just a little bit busier, so demand starts to fall off from spring to summer, and that's what's happening this year. So pending sales, as we would measure demand, has dropped 6% um, from May, from when it peaked this year, and that's 3% lower than it was this time last year. Uh, just for a little bit of context, if we look at the pre-COVID 3-year average, kind of the last time we had a normal market, 2017, 2018, 2019, um, that was 77% higher than it is now. We had 77% more pending sales at this time than we do now. So it's been quite a big drop off, and mostly driven by the rising interest rates. Uh, as far as uh, inventory, so we still see going into the summer, even though we see demand start to drop off, we still see more homes coming on the market. And the summer season, typically between the end of July and August, is when we see the peak inventory. And inventory has grown 26% since that peak in May, when demand peaked. And last year, we had a much later peak. We had interest rates that kept rising until October, when they reached 8%. And as a result, we had that late peak inventory in November. So that's unusual. Now, this year, uh, we have 36%, or I should say, this time last year we had 36% fewer homes than we do this year. Uh, but inventory is still 39% lower than it was in that pre-COVID average. So we're up from last year. We're up from this time last year, which is a good thing. We need more homes on the market. So that is a positive sign. Um, but we still have a ways to go on the inventory end of things, for things to really normalize. So we're still, again, 39% lower than where we would normally be in that pre-COVID average. We still have a lot of those homeowners that have the 2.5, 3, 3.5, 4% interest rates, and they're still hunkering down, and that's been a trend for a long time, since interest rates started going up last year. And it's we're seeing some of them come on the market, but it is still a trend that is continuing. That we've got those golden handcuffs. So look for that to continue. But again, inventory is trending in the right direction. Uh, so as a result of the inventory rising and the demand starting to fall, we're seeing the expected market times, the time it takes for a home to sell, from when you put the for sale sign in the yard to when you're packing up and you're moving, you're closing the sale. So we had a expected market time of 52 days at the peak of demand in May, and we're at 69 days now. So that is a pretty big slowing. But again, looking at kind of big picture context, when we're less than 90 to 120 days, we're still, like, technically in a seller's market territory. It doesn't really feel like a seller's market right now. We're um, starting to feel slower. We're starting to feel like a more balanced market. We're seeing less multiple offer situations. We're seeing um, more concessions from sellers, especially on the properties that aren't cream puffs. Those cream puff properties, the really Class A turnkey properties in the best neighborhoods, they're still getting multiple offers. They're still going a little bit over list price. So there's a depending upon where you are in the market, depending upon what you're listing, what you're selling, the market's reacting differently to it. So keep all of that in mind. Interesting to note that we have now had 34% of the active listing inventory has had a price reduction. So the market is trying to find where it's at, trying to calibrate, because we do have this reduced demand as buyers are watching interest rates, and as they sit above 7%, buyers kind of hold back. As they drop below 7%, that's when the market starts to pick up steam again. And now, as we see economic news that suggests the economy is starting to slow and those interest rates can drop again, look for that demand to pick up, especially as you get closer to 6%. We're going to see demand kick up much quicker. So, all of this slowing, all this inventory rising, it's really been driven a lot by higher interest rates, and we don't expect those higher interest rates to stay high when the economy starts to cool. So let's take a look at luxury, which is a little bit different than the rest of the market. So 2 million and up, kind of the base threshold for the luxury market. It's up 1% from an inventory perspective since its high in September of 2019, or that's the highest since September 2019. Luxury demand is down 12% in the past couple of weeks, and it's at its lowest point since January of this year. And expected market time has gone from 134 days to 153 days. So we're starting to see some of that cooling there. Now, year over year, inventory in the luxury market is up a lot. It's up 84%. And the luxury demand is actually up 4%. So again, we're seeing that kind of increased tension between the demand and the supply. Last year's expected market time was 86 days, so much faster than the 153 days that it is now. Luxury is always going to move slower than the rest of the market. So these 150, 134, 153 days, that's not really slow for luxury. Again, we're talking about a balanced market, just market wide being 90 to 120 days. So not terribly slow on the luxury end. But if we start to break that down and we look at the 2 to 4 million expected market time, that's at 110 days. If we go to 4 to 6, that is at 242 days. So there's a big difference between where you are in the luxury market and how that market is moving. If we go up to the 6 million plus, last year was at 365 days. Now it's at 1,620 days. So if you're in that segment of the market, just make sure you have a good product that is well prepared and well positioned. So a little bit more details. Fastest moving part of the market below 750, that entry level, is moving the fastest. Not actually the fastest. It's moving at 59 days expected market time, 1 day faster than it was 2 weeks ago. 750 to a million has gone from 51 to 54 days. A million to a million 25 has gone from 59 to 55 in the last couple of weeks. So some movement, in the million to a million 25, you're starting to get into some of the entry level, like single family, more towards the coast. So that's going to tend to move a little bit quicker than that 750 to a million for a single family in like East County. A million to a million 25 to a million and a half. That's where we start to see the slower market times. We went from 66 days 2 weeks ago to 77 days. So we're starting to see that get slower right when we're reaching about a million and a half. So all in all, the the positive takeaways is that we do have inventory increasing. That's been really the biggest issue that the market has been dealing with for several years now. So it's a good sign. The longer that rates stay up, the more we'll see the inventory increase, and that's really a good thing. But don't expect that to happen, because as the economy cools, we do expect to see rates start to drop. And when that happens, we're going to see demand pick up again, especially if it gets all the way down to 6%. Don't know if that's going to happen, but any drop below 7%, we are seeing the demand pick up. So that's what I have for you. Let me know what you think. Leave a comment, like, and subscribe for the next update. And if you do have any questions about your specific market, about your specific situation, please reach out. Doesn't matter if you're looking to do something in 9 days or 9 months, 3 months or 3 years. Always love to make the connection, have the conversation. Love to hear from you. You can find my contact information or my Calendly link for a Zoom call in the comments. So until next time, be well and God bless.